All right. Okay. Hello, everyone. Welcome. Thanks for joining us for the first webinar of 2022, Navigating a More Selective Market. This is brought to you by Saturn Advice. We hope you had a relaxing and safe holiday season with your loved ones and ready to embrace an interesting year ahead. I'm your host today, Joyce, a financial advisor at Saturn Advice. For those of you who've already dialed in, could one of you do me a favor? Just pop it in the chat box that you are able to see the audio and getting the sound okay? I'm just waiting for confirmation to come through. Fantastic. Thank you. All right. So let's kick it off. So who would have thought 2 years after the onset of COVID, we are still dealing with many uncertainties and restrictions. Despite all of that, the global share market ended on a strong note last year. However, since the start of 2022, we have experienced a few bumps in the road. It makes it quite timely for us to discuss what would shape the global share market this year, and more importantly, what it means for our client portfolios. I'm delighted to introduce our presenter today, Shahrukh Abdali. For those of you who don't know him, he is a frequent speaker on our webinars. He is a financial advisor at Saturn Advice, CFA charter holder, and also he sits on our investment committee. Welcome, Shahrukh.
Thanks, Joyce.
Now, before I hand it over to Shahrukh, I just want to go over some basic housekeeping stuff. First of all, let's just get the legal disclaimer out of the way. All the information presented here are general information only. These are not financial advice. If you need personalized financial advice catered to your specific circumstances, please reach out to a Saturn Advice advisor. Secondly, we will be recording this session. So in coming days, you will get an email with links to the playback of this webinar. Last but not the least, we do have a live Q&A session towards the end of the webinar. So if you have any questions throughout, don't be shy. Just pop them in the question box located at the left-hand side of your screen. Without further ado, I will pass it on to you, Shahrukh.
All right, thank you.
And I'll project the control as well.
All right, I think I can cut off. There we go. Right. Okay, so you've already covered the disclaimer side of things, so I'm going to skip that. Very quickly, we'll touch upon who we are as a business for those of you who are not familiar. So we are a group of companies, including 3 entities primarily. Saturn Advice is where we sit, which is primarily giving financial advice, investment planning services, and we also have discretionary investment management service on offer. If you want to find out more on that, please do get in touch. We have a pension scheme within Saturn Invest, which is primarily to accept pension transfers from the UK. And we also have National Capital, which is a digital advice business for KiwiSaver. And you can check out their website. They've got a free service where you can find out if you're in the best fund for your circumstances and goals. For Saturn Advice, the business was originally founded about more than 30 years ago. Wasn't called Saturn at the time, but we've been around for a while. We've got 2 offices, one in Auckland, one in Christchurch. Widely experienced team, and we'd be happy to address your financial concerns and help you navigate through your financial goals and objectives. The key part to highlight here is what makes us stand out from our peers is that we are an impartial business to the point where all employees are paid a fixed salary. There is no commission structure or bonuses paid out to anyone in the business. So as an advisor, I don't have a sales target to achieve at the end of the year, which means that all I got to do is give good advice and get paid for it. That's a business model which is not really going to come across too often if you were to go and look for it. All right, so on to today's session. What we'll cover is I'll give an update on different types of asset classes, as well as the outlook that I have for these. Starting out with international shares. So you can see, like, the international share markets have had a pretty strong run since the onset of COVID. Obviously, there was the sell-off that happened early 2020, but since then the markets have had a really strong run. And even before, so 2019 was pretty positive. Recent share markets have seen some volatility at the start of this year. And I'll get into the reasons behind that pretty soon. But what we are seeing, in my opinion, is progression towards a post-COVID era on the back of vaccinations. The developed world has progressed quite well with vaccinations. Most of the countries have got 70% or more of their population vaccinated. Some countries have made progress on booster shots as well, which is further enhancing the protection against severe symptoms from COVID. Because there will be COVID. I mean, that's just part of life now. We've got the Omicron variant right now. It's already past its peak in some parts of the world. Relatively new here in New Zealand. But there will be other variants going forward. So it will keep coming, but as long as we've got the tools to protect ourselves from severe disease, I think that'll allow us to move past COVID and move on with our lives. Now, more importantly, the biggest factor that has been affecting the markets and asset prices of recent times, and it's been the talk of the town per se, is inflation. So I'm going to spend a bit more time on explaining how inflation came about, because it was practically non-existent until very recently. Over the past 18 months, it has come up, and it's currently at multi-year, and in many cases, multi-decade highs. So what caused inflation to come back the way it did? So just wind back to when COVID struck. The world came to a standstill. People stopped spending because they were in lockdown. And obviously that resulted in the supply side of things, factories being shut, all the way from automobile manufacturing to oil rigs. Everything was set aside and shut off. Then the general consumer realized that financially they're okay. And this is not to say there wasn't really any suffering. I mean, there were obviously people suffering during that really testing time. But in general, people realize that if they aren't working, they're getting paid through wage subsidies, or the government is sending paychecks in the case of the US, or the likes of you and me, we'd be working remotely and we're still getting paid. So people were still getting money, but they couldn't really go out and spend it on the things that they wanted to do. So what they could do was they could order stuff that they wanted and get it delivered across. So there are two sides of spending from the consumers. There's the goods spending and the services spending. The goods spending rebounded super strong. Services, obviously, people were still stuck at home, couldn't really go out and experience things, or have a dinner or whatever services they wanted to enjoy. They couldn't because they were in lockdown. So all the money spending was done on the good side. And that resulted in a shortage because inventories were depleted pretty fast and businesses started ordering new stock. Now, on the supply side, that took a little while to ramp up, but, production was brought up. The problem was in between the demand and the supply, you had the supply chain. And the supply chain has got, a limited capacity. It's the same number of railroads, ships, containers, trucks. So even if the production is up to the level to meet the demand, you can't really just ship that across at a faster rate. And obviously there were some issues with the supply chain bottlenecks as well. So that created a bit of a shortage, which resulted in inflation. Now, where we stand today, the world is, as I said, moving past COVID. New Zealand is a bit lagging behind, but in general, we are moving past COVID. So people will start normalizing their spending behavior. So the demand for goods is going to moderate, and they'll be more focused on spending on services. Now, in the same time, businesses which had ordered all that inventory months and months ago will start getting deliveries because supply chain will obviously be delivering. That, I believe, can result in an inventory buildup because demand is going to be moderating at the time when they're getting all that stock which they ordered a few months ago. That shift in demand supply balance is, I think, going to result in a bit of a dampening in inflation. And I feel that we are months away. It's not like a matter of years. It's just like a few months where we are going to reach that point, and inflation would suddenly start to moderate. So we'll be past its peak later this year. Now, what is the central bank doing? And this is something that I've pointed out in my previous commentaries, that inflation would surprise on the upside, and central bank will have to change their outlook on the policy, and they have done so. Now they have started embarking on quantitative tightening. So to explain that, in simple terms, they are looking to reduce the money supply in the economy. When COVID happened, there was quantitative easing in place post the global financial crisis, but it was intensified further by increasing the money supply into the economy. And now what they're looking to do is to wind that back. But in combination with the quantitative tightening, they're also looking to raise interest rates. Now, raising interest rates is also going to have a dampening effect on inflation, because that's going to make it more costly for businesses to borrow, for home buyers to buy a property, pretty much for anything, like from all sorts of spending that's driven by debt will be more costly. So it will have a slowdown impact on the economy, and that's going to slow down the inflation. Now, the risk factor in there is raising interest rates too quickly can and has in the past resulted in recession. So that is generally considered a policy error, and I'm not suggesting that is our base case scenario. Central banks certainly do not want to cause a recession, but there is that outside risk that if interest rates are raised too quickly, this current economic recovery that we have seen since COVID could get stalled abruptly. But the immediate impact that we've seen so far is on asset valuation. So again, this is something that I had explained previously. When interest rates go up, that has a negative impact on asset valuations. So while we are going through this transitory period of rising interest rates, asset valuations will have downward pressure. And in most cases, interest rates haven't really started going up as yet, or not as yet as much, but share markets are forward looking. So the impact of that anticipated rate hikes or rises in rates is already being reflected in present time. So if you are wondering that the share market is already down by, say, 10% or 12%, and the rates are yet to start to rise, this is not to suggest that the markets have fallen for no good reason. They've fallen in anticipation of those rate hikes. And mind you, while the interest rates would be rising compared to historic levels, they'll still be pretty low, because they were practically near zero from where they started rising. So even if they go up to 2%, 2.5%, 3%, that's still below the historic average, which has generally been about 5 to 6%. So despite the increase, it's not like interest rates will be raised to really high levels. But that is the outlook for the economic growth. All these factors, the risk of COVID variants popping up, inflation resulting in higher interest rates going forward. Geopolitics is also resurfacing again with Ukraine, Russia, and then China also in the mix. with the US. All of that means that the outlook for economic growth is going to be a bit more moderate than what we've seen over the past year or two. The World Bank, for example, has reduced their expectation for global GDP growth from 5.1% to 4.1% going into 2022, and the same thing from the IMF. They expect about 4.9%. But again, that 4.1 or 4.9% growth rate is lower than what we've seen for the past year or so, but it's still higher than the long-term average. So while the economic growth is moderating, it does not certainly mean that we are going backwards. We're still growing, and so are the economies, and the businesses will be able to do okay if they're able to generate earnings. So that is where just before I move on, I want to point out that I'm often asked that share markets are really inflated because they've had such a strong run, and I would agree to some parts of the share market where there is a bit of a bubble, but bubble is probably a bit of a strong word, but the asset valuations are inflated. The bottom line is that if businesses are able to deliver on the expected earnings, the valuations are justified and future valuation growth is justified. So high cash generating businesses of present times, well, they'll be defensive in the face of further share market drops. So that's what investors need to be focused on, and that's what our fund managers focus on. But yes, if companies fail to meet the expectations on earnings side and downgrade their future earnings expectations, then that is going to be quite detrimental for the asset prices. And we've seen that overnight shares of Meta, or more commonly known as Facebook, dropped by 26% in a day, which is quite a hefty drop for a single day. But that was on the back of its earnings announcement, which did not meet the expectations, and they downgraded their future expectations as well. So yeah, earnings is the key. Moving on to Australasian shares. So New Zealand and Australia largely face the same factors as most global share markets, but the unique part is probably border control. New Zealand and Australia have had border control, more so New Zealand than Australia, in terms of their response to COVID. And in New Zealand, we've also had a prolonged lockdown last year, which you can see the impact of that in the near-term returns. The 3-month and the 1-year returns are much, much lower than what the Australian share market has delivered. And that's probably down to their government, the Australian government, deciding to persist with easier policy in the face of COVID, and New Zealand government being more restrictive. Whether or not these policies had merit is another debate. I'm not going to get into that, but the economic impact was that New Zealand economy, obviously, and the New Zealand share market had to take the brunt of it, and the returns were lower compared to the Australian share market. Also pulling down the returns in New Zealand on a relative basis is that the RBNZ was one of the first central banks in the world to start raising interest rates. We've already had 2 rate hikes of the OCR. Comparatively, the Reserve Bank of Australia is yet to start raising interest rates. They've indicated that they're following inflation, and they will look to address that by raising interest rates when appropriate. And the expectation is that they'll do it this year, but they haven't as yet. Now, within the economy, obviously, the border control has had an impact on tourism since the onset of COVID, since the onset of border controls, and tourism sector has been pretty negatively impacted. There has been some offset through government support as well as domestic tourism, but not certainly to the level of pre-COVID. But that should change with the government yesterday announcing that the borders will be opened progressively over the coming months in 5 stages. once the foreign tourist starts to arrive, that'll help the tourism industry and also the hospitality industry. And also, as part of that reopening process, the government announced that they'll start allowing foreign students to come. So that should bring in revenue for the education sector as well. So the reopening is definitely a really bright spot going forward for New Zealand as well as for Australia. The economic recovery is very much dependent on economic activity. And the economic activity is dependent on consumer spending. So consumer spending has been persistent so far, and that is very, very crucial, because if consumer spending gets slow, the business activity for the businesses will also be impacted, and businesses at the present time are struggling in terms of their confidence for the outlook. Primarily because they are facing quite a few challenges in terms of supply chain disruptions, inventory not showing up, as well as cost pressures. But biggest of all, the business survey that I've come across is pointing towards lack of skilled labor in the market. So businesses are really struggling to secure skilled labor, and that is a problem for their production capacity. And inflation, this general theory behind inflation is the same. I've already spent some time on it in the previous section. But one unique part here is that with the skilled labor shortage, businesses are having to spend more money in keeping their current employees, but also to attract new ones. So the inflation or the price hikes with relation to goods and services, they go up, and then they can also moderate depending on the demand and supply. But wages is one part of inflation, which is structural or permanent. Once you start paying someone, a certain level of wages, you can't just roll it back down to previous levels. So if wage inflation is to persist, that's going to be a more structural contributor towards inflation. So fingers crossed on that one. Once border control is released, there is hope that skilled labor is going to come from overseas, and that should help ease that pressure. The central bank policy I've already touched upon. RBNZ is already on to with their quantitative tightening as well as raising interest rates, and that is impacting the asset valuations negatively. International infrastructure. So there are different types of infrastructure, but what I want to start with is this is one asset class which did not really provide any reasonable returns for the first 12 to 18 months since the onset of COVID. And mind you, at the same time, the share markets had a brilliant run, with most sectors providing really good returns, even the defensive side of the portfolio. But the growth assets were having, the run of their life kind of time. But infrastructure was so subdued. And reason for that was the world was largely still stuck at home. People weren't really using the airports, the toll roads, the bridges. So there wasn't really revenue generated by the infrastructure assets. So infrastructure in general wasn't performing well. Now what's happening is I'll come to with the reopening bit and what that is going to do. But governments have embarked upon a lot of infrastructure spending, and what that is going to do is it's going to create more jobs, and there'll be new infrastructure assets that'll come online, and existing infrastructure assets will get renovated. So either way, there'll be more opportunities for fund managers to acquire infrastructure assets, which will be generating more revenue. So that's from the investment point of view. But in terms of the reopening, there is definitely a return of international travel now, with the world moving past COVID, and we are still well behind in terms of pre-COVID levels, but I'm very confident that we'll continue to move forward from where we are, and international travel will continue to recover. So that is obviously beginning to increase the usage for airports and the revenue that airports are generating, and it will continue to recover going forward. People are still preferring to drive versus using public transport, although public transport is also picking up. But either way, people are getting out and about more, whether that's for business or for leisure. We're getting out of our homes more than we were 12 months or 2 years ago. What that is doing is, increasing the usage for toll roads and bridges, and with that increased usage, that is also generating higher revenue. Energy infrastructure is also recovering really well because the price of oil obviously plummeted when the world went into a shutdown when COVID struck. But now when we are coming out of it, we've started using, the planes have started flying, we are driving, we're using public transport. So demand for oil has returned, and so has the price of oil. Mind you, the price of oil has come up to a level which was higher than the pre-COVID levels, and the reason for that was primarily once you shut down an oil rig, it's not just like turning back the switch and it's up and running again. It takes time. So supply on the oil, for the oil is it's lagging a little bit, but it'll come back. So right now oil price is at a pretty high level. So that is helping the energy infrastructure assets, and they are making more money. Utilities is one part of infrastructure which is just being sort of constant. While we were shut at home, we were still using power and water. Yes, there was probably a bit reduced usage of power because offices were shut, but maybe somewhat offset by increased usage of power at home. But generally, utilities infrastructure was still generating revenue even through the COVID lockdowns. Going forward, there is obviously a bit more recovery with people returning to offices to some extent, at least. I'll cover that in the next section. But there is a lot of investment going into efficiencies into the utilities infrastructure, so improving the efficiencies, and that is going to improve the profit margins for utilities infrastructure. So there is upside for that side of infrastructure as well. So in general, I think this asset class is nicely placed going forward. Property, start with disclaimer that I'm not talking about residential property here. This is commercial property, and that too listed on the stock exchange, New Zealand and Australia. You can see again the New Zealand listed property has underperformed compared to the Australian listed property, and that's primarily for the two reasons that I've talked about already. We had a prolonged lockdown compared to Australia, and the interest rates have started to go up here ahead of many parts in the world, and particularly Australia. So both of those have had negative impact on performance of listed property in New Zealand. Within the property sector, the subsectors, office, as I've said, people are returning to offices, but there is, the work from home concept was non-existent pre-COVID, but that's a very normal thing now. So going forward, I do feel that there is going to be a hybrid approach. Some people would be working from offices for parts of the week. Other days they'll be working remotely. Over the longer run, I think there will definitely be a return to offices. But will we go back to offices the way we were pre-COVID? I don't think so. I think working remotely is very much an established concept now. And there will always be a hybrid approach across most industries and sectors. So what that means for the office space is collectively there will be reduced demand for office space. There will be demand for newer developments with modern facilities and at good locations, but that will be at a cost of existing office space which is already there. Now that office space might get renovated to bring it up to the standards for increased demand, or might get repurposed for something else. But as a whole, office space, so property companies, which are very much dependent on investing in offices, will have to figure out how to get through this transitory period and where are they headed. Industrial sector has been in really good demand with supply chain disruptions causing a spike in demand for warehousing, but also once the supply chain disruptions once they go away or moderate, I think there will be structural demand for warehousing simply because e-commerce has taken a lot of strides over these past 2 years when people were stuck at home and they couldn't really go out to the shopping mall and they had to do most of their purchases online. So people got introduced to e-commerce and they got comfortable with it. They know, they make a few clicks and it shows up at the doorstep. So I think that trend is going to continue, and that means that there'll be increased demand for warehousing going forward. Talk about the impact of interest rates. Hospitality industry is, as I've said, it's dependent on the border control, and with borders reopening, that should recover over the near term. Now, retail should also benefit with border reopening. With tourists, they not only spend in hospitality, they also spend money on the retail sector. They do a lot of shopping. But more structural shift that has been happening even before COVID, but got accelerated, was the shift towards e-commerce. I don't have the updated number, but the last time I checked, a few months ago, e-commerce accounted for a bit over a quarter of all retail sales. And I think that balance is going to shift further in the favor of e-commerce as time passes. So for the retail side, I think there will be a transition that needs to happen. The shopping malls, the typical shopping malls, the shopping strips will need to adapt to this changing demographic, the changing consumer habits. Without an online presence, without a presence in the e-commerce space, I think businesses will really struggle to survive, let alone thrive. So we'll have a shift in terms of spending within the retail sector on that front. Now, fixed interest is the defensive side of the portfolio. Largely, I've talked about inflation and interest rates, and they have a similar impact on fixed interest, the same as shares or any asset for that matter. I can explain that a little bit more in terms of a bond that gets issued. Say the interest rates in the market is 5%, and the bond gets issued paying a 5% coupon rate, and it's valued at $100. Suddenly, the interest rate are dropped to 2%. Now that bond is a lot more valuable than $100 because it's paying 5%, while the new bonds that are getting issued are issued at 2%. But on the flip side, if now that bond is valued $150 and somebody buys that and the interest rates are raised again, then that bond is not valued at $150. It'll be valued at less than $150. So that's essentially what's been happening to the fixed interest side of things as well. The bonds that had been issued or valued at lower interest rates when the interest rates were dropped are now being revalued because the interest rates are on the way up. You can see there's a slight positive on the quarter, but that was largely because interest rates sort of moderated a little bit towards the end of the year because of Omicron surfacing at that time. But for the year, the return is negative, and people often ask me that this is fixed interest and it's supposed to be defensive. Why is it negative? So I've explained why it is negative, and it is negative for a transitory period. But what I want to point out that while it is negative, the magnitude of this negative is what, -1%? Well, -1% isn't really hugely negative. It is negative, but compared to the impact on, for example, shares, which can be double-digit negative in a year if circumstances are going the other way, this is still very much holding the argument of low volatility. While the volatility is there, it's negative, but volatility is much lower compared to the shares that you would have in the portfolio. So the argument of investing in fixed interest in a rising interest rate environment yes, it's unlikely to provide really high returns, at least for the near term. The argument is very much there about the lower volatility or dampening of the overall volatility of the portfolio. And that's pretty much it for the fixed interest side. What I do want to point out before I move to the next one is once interest rates are normalized at a higher level, that also means that fund managers will be able to invest in higher yielding bonds, because newer bonds will be issued in line with the higher interest rates. So over time, once this transition period passes, actually, the yields will improve on the bond portfolio. So that should get reflected in the returns. On the New Zealand fixed interest side, the negative returns are there. Meaning you can see those, and it is more pronounced because, as I said, RBNZ was well ahead rest of the world in terms of raising interest rates. So the impact is much more pronounced. Inflation hit a record high here as well. So RBNZ responded to that, but I've put in unemployment there simply to highlight the fact that unemployment has dropped to its lowest level for over a decade. Since 2007, it hasn't been as low as it is now. But that is despite an increase in job listings. So unemployment is fallen while job listings are still high or are increasing. How does that work? The only thing that explains that is lack of skilled labor or lack of people suited for those jobs. So that just endorses my view that with border reopening, we can hope that skilled labor is going to come in from overseas, and that's going to help alleviate that part of the inflation. Now, with the policy from the central banks, probably missed out on that when I was talking about international shares and shares in general. Central banks do not want to cause recessions, as I said. Now, as soon as they see inflation moderating, they will be they will signal that for their policy outlook, and the markets will adjust accordingly. So when I said inflation, I expect to start moderating later this year. Well, central banks will be very keen to signal that to the market to ensure that there isn't really further harm done to the economic recovery. Because if share markets continue to fall, that will have a depressing impact on the investors, and investors will consolidate their spending. And if they consolidate their spending, that slows down the business economic activity, and that causes a recession. So that's how it works. But so I feel that we are not too far away in terms of a rebound. Now, I've also got in there outlook from New Zealand dollar, and primarily being a commodity currency, typically when economic recovery happens, there is more demand for commodities, and that means that there's an appreciation for New Zealand dollar. It's pretty hard to really predict the near-term movement for a currency, but that's one of the factors. On the flip side, the US dollar, for example, is considered a safe haven asset. So if there is further volatility, whether that's through COVID variants or geopolitics or a recession on the horizon or things like that, that's going to result in appreciation for the US dollar relative to the Kiwi dollar. But there are other factors which have an impact on it as well. Now, I've also included a graph in there comparing term deposits to inflation, and that goes all the way back about 60 years. And you can see that inflation has just started to spike, and this spike is being it's making headlines, but relative to historic levels, it's still not really out of control. I mean, that was out of control in the 70s and 80s when it was into double digits or high teens. So current inflation, while it's high, it's not really yet to that point. And term deposit rates are beginning to turn up, but they're not turning up in a hurry, which means that term deposits are actually going to take you backwards. So if you are invested in term deposits in the current inflation environment, you're actually losing money. It's not just getting 1% return. You're actually, in real terms, you're actually going backwards because inflation is much higher than 1%. Now, just to bring it all together, this is to highlight the fact that you shouldn't be focusing on one type of asset or one asset class, but actually you should be investing in across different asset classes, and not just across different asset classes in one part of the world, but spreading it across different regions. That is to achieve optimal diversification and to minimize, the risk. Because if something happens in one country, even if you've spread yourself across different types of assets within that one country, you're still going to get affected because the whole country is getting affected. I've got an analogy there for umbrellas and a sunscreen. So if you were to invest in sunscreen and umbrella, when the umbrellas will be in demand, the sunscreen might not be in demand. When the sunscreen might be in demand, the umbrellas might not be in demand. But either way, they'll offset each other, and your returns will be much smoother than the cyclical volatility. In this graph, I've got the past returns for different types of assets over the last 30 odd years, and the shares have been the outperformer. What I want to point out here is New Zealand property in this graph is actually New Zealand residential property, and for particularly if I've got property investors in the audience, they'd look at that and really their jaw would drop as to that can't be right. 4.9% per annum return. That is without leverage taking into account. So leverage is the biggest advantage of investing in property. If you had only put in 20% of your capital and the rest of that has been borrowed, then that 4.9% actually is times 5 in terms of your return. So 25% return is what you would have achieved, and that obviously is well above what you could have got from shares. So wealth accumulation is for shares. Once you're past the wealth accumulation phase and you want to diversify across other assets and want a more stable return, that's when the likes of us come into play. This graph is to highlight that share markets go through periods of volatility all the time, but they always bounce back, and they bounce back stronger than the downturn. So this is the U.S. share market going back 100 years, and you've seen the big downturn over there. That was the Great Depression, and the reason that it took so long for us to have a positive return from that was there wasn't any policy support whatsoever from the government or central banks. So the economy was left on its own, and it took quite some time for businesses to come out of it, because a lot of businesses folded, and until new entrepreneurs come in and start setting up new business and start hiring new people, the economy doesn't move forward. But that is not the case right now. What we had in terms of COVID, that's the needle over there. That was the share market return and the recession. We've already rebounded quite strongly, and we already passed that. So right now, this policy support was very much on time and was there to be had, and that allowed businesses to survive through some extreme periods of economic shutdown and get through at the other end. But you can see, the drawdowns have been there. That's the global financial crisis, the dot-com bubble before that. That was the 87 crash. Some of you, if you were around back then, that was, a big event. 87 crash, that was all that was, and, followed by such a long rally. So if you were to exit the market during the sell-off thinking that, okay, well, I better save the money that I've got, you could be missing out on this whole rebound following that. So it's always good to talk to a financial advisor who can, broaden the horizon and make things easier to understand. Now, the returns that we've achieved over for our strategies, for conservative all the way to very aggressive, we've got a different split across each of them. Income is defensive type of assets, and growth is the growth side of assets. I'd encourage you to focus on the longer term return rather than what's happened over the last quarter or 1 year. That's not really representative. The longer term returns, you can see as you go down the risk spectrum or growth oriented strategies, the returns have been really strong, and we take pride in in the research that we put in to choose the right fund managers and the right mix for our strategy. So yeah. Well, I'll probably stop there and see if there are any questions, and then we can look at some of the slides.
Yep, absolutely, Shahrukh. Thank you for the valuable insight. Lots of relevant stuff. I mean, as a consumer, I certainly can relate to what you said about normalization of consumer purchasing spending behavior. After the lockdown, I myself, for example, has purchased a lot of coffee capsules, enough supply for the next year. And I can't drink more than 2 coffees a day. Otherwise, I'll be bouncing off the wall. And that just pulls, I guess, the future demand forward to today. I won't be buying coffee capsule for a long time. And I think that will be mirrored across the economy, across the whole population. So I'm in the camp that inflation will be moderating very soon.
Yeah, add toilet paper to that mix.
Absolutely.
Yeah, please carry on.
Yeah. So I'm conscious of time. Let's move to the Q&A session. We will, since we've got the inflation, since we are on this inflation topic, I just want to put forward a related question from Pat. So the question is, will your recommended investment rate beat the current inflation?
Well, that's the idea. If we aren't able to do better than inflation, then we won't be in business, will we? Because without beating the inflation, the real return would be negative. So despite the investment, we'd be going backwards. So yes, I would be pretty confident that our strategies will be able to do better than inflation. Yes, there are periods, as inflation has spiked right now, and that is going to cause, and it is causing a reassessment of the asset valuations through this transitory period. But once inflation settles or starts to moderate, asset valuations will recover accordingly as earnings come to the fore, and that is going to result in long-term returns. So long-term returns absolutely will be higher than whatever the inflation rate is.
Yep, great, thank you. And as you rightly point out, the bottom line is that take a medium to long-term view. And I guess if we look at things retrospectively, the strategy, our investment strategy performance that's demonstrated, displayed on the screen, it shows that we have a track record of beating inflation. So moving on to the next question, there are actually a few questions kind of all related to market timing. So I'm just going to sort of group them together. So the question is about, looks like we are experiencing this tug of war between rising interest rate expectation and asset prices. So people are sort of thinking this is going to be a pretty volatile year. The questions that I also been getting from my clients is that, should I get off the trend a little bit, in the sense cashing up, or should I slow it down a little bit, in the sense switching to a lower risk strategy, or should I follow the old age wisdom of buy the dip, actually, buy more shares, enter the market right now? What are your thoughts on that, Shahrukh?
Right. So I've explained the reasoning behind, what's causing the market pullback. That's largely driven by inflation and the expectation of rising interest rates. So all the pain that is being experienced so far is on the price side of things, not the earnings. So earnings estimates so far largely are coming in line with what the expectations were, as well as the future growth earnings expectations. If that part of the equation hasn't really changed and the price has fallen due to some exogenous factors, then all that means is that future earnings are on offer at a cheaper price because the price has fallen. And that's how I encourage all my clients to look at things. So if the investment case for which they initially invested hasn't changed, if that has changed or their circumstances have changed, their needs have changed, then that's a different story. You gotta review that and make some changes. But in absence of those changes, if you're still wanting what you were wanting when you set up the portfolio, and the asset that you've chosen to invest in that hasn't really structurally changed in its outlook, then all that future value potential is on offer at a cheaper price. So I would absolutely be in that band camp of buying the dip rather than going conservative, because that classic example was a client of mine during the COVID sell-off. Panicked, obviously. It was quite a bit of a drop, and they went into conservative, cashed up, and they cashed up 4 days before the market rebounded. And the market rebounded in a hurry, and when it rebounded, typically the initial expectation is that, that's just a spike back up. It's not going to continue on. We'll have further downside to this. And you wait for another few days or a few weeks, and before you know, you've missed out on a 30-40% return while having ridden down the sell-off. So I'm not saying that we are around the corner from a 30 to 40% return, but the markets tend to rebound, and they rebound rather strongly. So we will come out of this at the other end, and we'll start moving on forward.
Yeah, thank you. Thanks for sharing that. And the story of people panicking and cashing up, almost close to the bottom of market. I mean, it's quite sad to hear that. And as a financial advisor, I mean, I can certainly resonate. It's important to stay the course. And I think that's also where the financial planning come in. Before you invest your money, you set it up properly, understand what you're trying to achieve and what kind of strategy going to get you there. And at the forefront, you are very clear why you invest in what you're investing in the first place. So when things don't go well, you just kind of ask yourself, has anything changed? If not, why would you change your strategy? So we have another question coming through. So Shahrukh, the question is that, so is property a good inflation hedge, and is now a good time to invest in rental property?
Interesting. So my view on property, and I'm assuming the question relates to residential rental property. So my view on that is that property market has had a very unique golden period of 8-9 years where everything was aligned to result in property price appreciation. And where we stand today, that is very unlikely to come around, if at all. So what happened was the demand got really high. And are there any other questions? Because I could spend like 3-4 minutes on this.
Just one more after this.
Okay, so I'll just try to be pretty quick. But the demand got up because net migration was record high. It never really has been persistently positive for New Zealand, simply because skilled migrants never really put New Zealand as their top priority. They always look for bigger economies with better job opportunities rather than come to New Zealand. But global financial crisis shut the door on those economies and created that period where they only had New Zealand or Australia, the commodity economies, which fared rather better during the global financial crisis, that they could come to. So they came here. And now, once the borders are reopened, I doubt that they'll be again coming back here because, it's still a small economy. It's still the job opportunities are limited. I mean, limited by account of, other bigger economies. And the property prices are, one of the highest in the world. So why would a skilled migrant looking at leaving their hometown or home country would want to come here? So I think even when the borders are open, there will be limited demand from migration, and the Kiwi expats that came due to COVID are already looking back overseas for their better paying opportunities. So there will be lesser demand on that front, and obviously the tax laws and the tenant-friendly policies that have been put in place is going to subdue the demand from investor side. At the same time, you've got supply coming online. With the years of shortage, property construction sector has developed and it's booming now. So supply coming at the same time and demand is subdued and interest rates going up, well, that is not really a scenario where I would be jumping at investing into a rental property.
Thank you. And the last question is, how do I avoid loss in the current market?
Well, okay, so the only sure shot way of countering volatility is diversification. So you can do really well if you are invested in, for example, just shares or just New Zealand shares. You can do really well by diversifying yourself across different asset classes. So our strategies typically would have about 15 to 18 funds. Each of those funds would be looking at different sectors or different regions. There would be very little, if at all, any overlap across the different fund managers. So we've got exposure for our clients to about 500 to 1,000 plus underlying companies, carefully chosen, well researched, and everything by the respective fund manager. So diversification is how you can minimize risk. Whether you can totally avoid risk or avoid the losses, well, that's not really possible. If you're looking to make a gain, you got to take a risk, and for the short term, there could be periods where you would be looking at a loss. But I always tell people that a loss in an investment asset is not a loss, particularly in an investment portfolio, is not a loss until you sell, until you shift to other assets. So you sell out of an asset, that's when you make a loss. Until that point, it's a paper loss, it's an unrealized loss, which can be recovered by staying invested and staying put. So that is probably the biggest tip for anyone listening or worried about the current volatility. Staying put and look for opportunities, because high quality assets will be on offer at cheaper prices because of the recent sell-off.
Great. Thank you, Shahrukh. So the message is loud and clear. We need to diversify and make sure we stay the course and just trust the process. Thank you very much. And that's the end of the questions. Thanks to everyone who listened in. I hope you got as much out of that as I did. As promised, we will be sending a recording and Shahrukh's slide deck in the coming days. If you do have questions or need help with your financial planning, please do not hesitate to get in touch with Shahrukh or myself. If you want to find out a little bit more about Saturn, hop onto our website. And on the insight section, there are heaps of good articles and videos written about the market. So we look forward to seeing you at the next webinar. Thank you. Bye.
Bye. Take care.